Good morning, ladies and gentlemen. Happy Saturday to you all. Today we're going to be going over our weekend deep dive where we give you all the key levels for the market, biggest winners and losers, and give you our own personal thoughts on the market. And if you guys were having a struggling week in the market, I'd like to leave you before we start the video with a quote. Everyone has a plan until they get punched in the face, by Mike Tyson. And that is a true statement. I got punched in the face multiple times this week in the market, and I'm sure a lot of people did with the volatility. And remember, you have to be willing to admit when you're wrong and change your thesis. We're going to be talking about that very much, and that's kind of the generation of the tide is shifting title, where a lot of the bears are being very vocal about why we have to go down. I was one of them. Keyword was. I am turning more bullish to the market cautiously, but I started taking more bullish plays this week, and we're going to dive into that on the key levels of more of why I shifted my stance on that. All the sections will be timestamped down in the description below, so feel free to skip around to anything, biggest winners and losers, or the key levels, or even the debate if you just want to hear our own personal thoughts at end. But just recapping the market move this week, we basically kind of went a whole lot of nowhere. If we look at the weekly on the S&P, we did have a push up above our previous week's high. NASDAQ kind of just stayed within the range of the last week. So definitely a notable week for both indexes. Tech didn't do as much. However, it was leading significantly. And maybe this is a cooling off period, flagging out for the big run up possibly. S&P, we made forward progress. And we're going to talk about each of these days individually on the key levels, just because we have to be very crucial of what was generated on each day. We did have the CPI print, the PPI print this week, both of them coming in significantly better than expected. PPI came in absolutely murder. CPI came in at expectations with slightly better numbers for the bulls, but the reactions were very mixed. And we also had some Fed speakers out this week that will be covering all of that in the key levels. But for now, guys, we're going to jump over to the biggest winners and losers. So Fatal, take it away.
Thank you for that, Mike. Now, the week for the market, guys, was just absolutely insane. As you can see on the 5-day, it is actually up 0.8%. Normally, I would say that that's a lot, but I mean, if it's anything less than 2% up or down, it's pretty much flat, right? So you can see that the market pretty much did 0.8%. And even after earnings came out for the banks, the market actually fell, which was really much of a surprise. Now, I will cover the earnings in my own videos throughout this weekend. Nonetheless, though, you can see it didn't do too hot. In fact, if we take a look here on the day, guys, it was flat, 0.04 ending on Friday. So overall, it did absolutely nothing. And even though we had a massive week with CPI and with earnings and even PPI, it still didn't do as much of a gain or decrease as we were thinking to begin with. So looking at the S&P 500 heat map, guys, we can definitely see this. The banks were the ones that mainly brought everything up, which again was very actually it wasn't surprising at all because, I mean, they had earnings. But nonetheless, though, let's jump into the technology sector. Here, the biggest gainer overall, guys, was none other than the company Enphase, the solar company, gaining 9.37%, and the biggest loser from what it's looking like would be the company Intel Corporation, losing 2.8%. Looking now into the communications, guys, very flat sector overall. In fact, there really wasn't much of a gain of pretty much anything, and it's sad to say that because, I mean, you know, I just hovered over a few, and you guys just saw like 2% here, 2.5% on Meta. Yeah, apparently that's not a lot, right? Because unfortunately, this is the reality that we're in right now. Nonetheless, though, the biggest gainer from what it's looking like, guys, would be, well, it would actually be the company Take-Two Interactive Software, gaining 3.42%, and the biggest loser from what it's looking like would be, well, actually, yeah, it would be the company Dish Network, losing 10.6%. But as you can see, Lumen fell 6.58%, which, by the way, Mike has said that Lumen has the possibility of going to zero from a technical analysis standpoint. I should definitely do an analysis, a fundamental analysis on Lumen to see if I get kind of the same thing, because that video has gotten a ton of views. If you guys haven't checked it out, make sure to check it out. And it's still falling. I believe he made that video at like $3 or something. It's currently at $2.27. And the other one that also fell a significant amount was Warner Bros. Discovery, losing 8.8%. Looking now into the consumer cyclicals. Over here, the biggest gainer would be, it looked like it was Nike, but from what it's looking like, the biggest gainer would be a company over here. Let me see if I could just find it in just one second. it would be the company, from what it's looking like, guys, it is the company KMX, CarMax. Okay, gaining almost 8%. And the biggest loser, from what it's looking like, it is the company Ball Corporation. I don't know if they made like disco balls or something, but they lost almost 5%. Looking now into the consumer defensives, very once again flat overall. A lot of red though, a lot more red than green. Nonetheless though, the biggest gainer from what it's looking like, guys, it is the company Molson Coors Beverage. Wow, that's actually hilarious because of the whole, no, if you guys don't know, there's a huge controversy right now happening with Anheuser-Busch, and Molson Coors, apparently it's like the thing to go now. So very interesting that they gained 7.5%. And another one that did a pretty good was EL, 5.29%. And the biggest loser, from what it's looking like, guys, would be the company Cisco, losing almost 5%. And now taking a look at the banks. This one, in my opinion, was the one that brought everything up, especially on Friday. JP Morgan, Wells Fargo, Citigroup, BlackRock even, right? BlackRock. And I believe, which one was the other one? And PNC all had earnings today, guys. And from what you guys could see, everything here, well, at least from the ones that I just said, gained a lot. The only one that was flat, it was PNC. You know, it only lost 0.03%, so it was essentially flat. Nonetheless though, you guys can see the bank, whoo baby, the banks diversified. Everything here is green. Even Bank of America that didn't even have earnings, it was green still. Wow, absolutely insane. So yeah, the best performer in this sector would be the company JP Morgan at 8.83% gain, $138. That's absolutely crazy. During COVID, this thing was at 90. So if you, oh man, if you bought at 90, that's absolutely insane. And you can see that Citigroup followed very closely at 8.07, and then Bank of America at 6.03, BlackRock at 5.32, and Wells Fargo at 4.59. Now, the biggest loser would actually be this, well, I don't know if it's PGR, the Progressive Corporation lost 7.77%. But over here you see something else. First Republic Bank, of course, losing 6.49% on the week. That's insane. 6.5% on the week. $13.12, guys. Just a few, I mean, just like last month, actually 2 months ago, this thing was at $100+. Now it's $13.12. So you can see that, yeah, a lot of money is flowing into the banks diversify, guys, and essentially everything is being taken away from the banks regional. So really is sad. Nonetheless, though, the biggest gainers was none other than JP Morgan, and the biggest loser, from what it's looking like, would be the Progressive Corporation. Looking now into the healthcare, very flat overall. Nothing too major happened here. From what it's looking like, guys, the biggest gainer would be the company Biotechnic Corporation, otherwise known as Tech, the ticker symbol TECH, gaining, oh, that's absolutely insane, 12.68%, and nothing else got close to it. In fact, Align gained a significant amount, but it was half of what Tech did. And I believe this one over here gained 6.17%, UHS. But nonetheless, though, the biggest gainer would be the company Tech over here. Now, the biggest loser would be Catalent, losing an astounding 28.68%. Overall, though, everything was flat, you know, nothing too major happening overall. Pretty quiet when it came to the sector. Looking now into the industrials, very green. In fact, I believe this is the second most greenest one that we have seen so far. With the industrials, guys, I mean, you guys see here the farm and heavy machinery gained massively. In fact, the biggest gainer is by far the company Caterpillar, gaining almost 7%. You have other ones down here as well. Actually, yeah. You got over here Stanley Black & Decker gaining 6.91, you know, 4 off from what Caterpillar did. But you have like URI, United Rentals, gaining 6.41. So a lot of green here overall. Now, the biggest loser, it's none other than American Airlines, losing 8.71%. But also, you know, Boeing lost 4.6% overall as well. So a lot of green overall. Nonetheless, though, you did have just like 2 main red ones. Overall, though, very green sector. Into the real estate sector, very red. This was actually surprising. I just saw this right now. Very red. The biggest gainer would be the company Weyerhaeuser. I actually done this company before. I can never say the name. Weyerhaeuser company gaining 4.12%, and the biggest loser, from what it's looking like, guys, would be the company PSA, public storage, losing 6.6%. And on top of that, shout out to Realty Income losing 2.88 as well. Guys, this company is about to fall under 60 again. And I love my Realty Income under 60. So if this thing falls under 60, I'm probably going to be loading up the boat as well on Realty Income. I absolutely love this company. Looking now into the utilities, the green has finally ended when it comes to the utility sector. Everything here was mostly red. 2 companies gained, actually 3 companies gained. But the biggest gainer from what it's looking like, guys, would be the company AES gaining 1.89%, and the biggest loser would be the company EVRG losing 3.05%. But as you can see though, even with that, guys, this sector, there's nothing majorly red overall, right? So there was essentially, in today's market, it was essentially flat, even though, a loss of 3%, for example, on ETR is nothing to scoff at. And of course, looking at the energy sector, the most meme-worthy of all the sectors, everything here was green except for one company, and that was none other than Valero, the worst performer. However, the best performer would be the company PXD, Pioneer Natural Resources Company, gaining 10.5%, and the biggest loser, as I said, it is Valero, losing only 0.5%. So still very green sector overall. And apparently, guys, one of the banks or one of the rating agencies mentioned, I saw this article, mentioned that Chevron may actually surpass ExxonMobil. So yay, because I hold Chevron. So that's really good, at least for me personally. Nonetheless though, very green sector overall. And lastly, taking a look now at the basic materials, everything here is green except for 2 companies. The worst performer would be Newmont, losing 4.5%, as well as ECL only losing 1.6%. The biggest gainer though would be, it's looking like a company over here. You got, wow, everything here is in the 7% plus. That's crazy. Well, biggest gainer, CF Industry Holdings, 7.6%, MOS 7.6%, and FCX Freeport McMoran 7.32%. Aside from that, guys, everything here was pretty much flat, or if not 1%. And again, only 2 losers, ECL and Newmont Corporation. All in all, here is the S&P 500 for the week. Honestly, I was expecting a lot more green, especially after CPI coming in at 5%. And then on top of that, the banks absolutely crushed it. So interesting that it only did, 0.8% on the 5-day, as we see here on Seeking Alpha. But that pretty much does it for this segment of the video, guys. Take it away, Mike.
So guys, now for the key levels on the market. We do this every single week. I can't make it as simpler as I can, and this is why I talk about what is the weekly high, what is the weekly low. So for S&P 500, you're basically going to go to the weekly graph, and you're going to throw a horizontal ray on top of high of the week, low of the week. That's your support and resistance. Now, I do have 409.70 on the S&P 500 highlighted for a reason. That number is generated off our previous month's high. So as long as we stay above our previous month's high, and actually I'm going to move this down to the close of the month, which was at 409.39. So that is going to be the level that I want to not see broken. I want to see continuation from the previous month, and that's going to be a key area for me. What's important is we consolidated around this region of that 409 level during this week. So we're seeing defense by the bulls, we're seeing offense by the bears, but being frank with you all, you had bulls give the bears an opportunity to get over leverage. And what do I mean by over leverage? So if we jump over to the net speculative positions, this can be found on investing.com. Just look up CTF net S&P speculative positions. This is future contracts. So you have to, think of this. This is all margin. This is all high risk. This is all pain trade crazy. We had on April 7th, they added between the 31st and April 7th. So let's go take a look at what happened on April 7th. So here they added to their position during this week. So during this consolidation period here, so mean price, let's say 407. We're 412 right now, guys. So they're already losing on this position that they added, and they're refusing to relent. So they're going higher. They're already in a pain trade that the average price that they initiated this pain trade, as I'm going to start terming it, back in June or July, around this big drop here. So around the 395, 398 level, let's say, just general general price region there. So they're nearly down, I would say, if we take it from the 396 level all the way to now, they are down about 4% roughly on the trade, and they're refusing to relent. So why can this is important is that's the fuel to send us higher. We've seen what happens with short squeezes when, if we go back to the crazy rallies that we can get from CPI days, where we have these crazy short squeeze rallies of 3% in one day, and you only have about, that's like a 50,000 position close. You nearly have way over. You're going back to the lowest we were here was 2020, July 19th. Well, let's go back in history and see what happened after that. So going back to 2020, July. So we had this red candle here, and then we ignited this massive, absolutely massive rally. So what is stopping us from doing that again? I really don't have a good answer for that, because I don't think that until something breaks that the bullish momentum is going to stop. You have this trend line here, you haven't broken it. So here's the thing, you're so far away from this trend line, yes, you could get a pullback, and we're gonna get a pullback. Let's not get ahead of ourselves. But what I'm seeing is a to B pattern playing out here, A to B, B to C. We've traded above it, closed above it, projecting up into the 430 level that we've been talking about, to set that trap or set that real bearish trap for the bulls. Because, I'm always thinking how the other side can get over leveraged, but if I'm looking at it now, we're seeing that the bears are getting over leveraged, and they could be the fuel to go higher. You broke above last week's high, so they have to basically push it down below last week's high of 405, which would be to our trend. Why is that mimetic? Because if you push it back to this trend line and you bounce, you're just going to create the biggest rally in existence for the bulls. You'll invigorate them like no tomorrow. So as long as we have our long-term uptrend and our short-term uptrend, which you can see forming in the daily graph here, I'd definitely be looking to go higher. On top of, you have the moving averages starting to cross over. You have the 200 daily crossing over the 50 weekly. So a continuation of short-term price going bullish, and usually volume starting to pick up on the daily, kind of giving you more bearish volume, but also bullish volume. If we look at the 1 hour chart, we can clearly see that we're starting to see a fight between the bulls and the bears here, where one side is going to get a clear advantage in the short term, and basically price is going higher. So you can easily see that we're making higher lows, higher low, higher low, higher low, higher high, higher high, higher high. So until that stops, you have to stay bullish. You can tell me how bearish the market can be, and I was there, and I'm going to admit that. And until that theory ceases to exist, then, well, we're just going to keep going higher. We have the fuel to melt up. You have the CPI data. And here's the question I have for all the bears out there. What happens if Powell says, well, this is the last rate hike? You think your positions are safe then, and you're going to be hoping for Powell to save you? I've been there, done that. It never works out. Just close the position, move on. On top of, on the S&P 500, we've had this symmetrical wedge that we've been in. You just broke. Price target on that, we're going to be conservative, is around, if we break this wedge, break up higher, it brings us back up to the 450 level on the S&P, which would be absolute insanity. On top of, if you look at the big names in the S&P 500, mainly Apple. Apple is getting very close to this trend line. If Apple breaks this downtrend, it could start tackling all-time highs. Are you hearing me right? Apple tackling all-time highs. On top of, it has a possible A to B pattern on it, that we have A to B, B to C. Hasn't traded above it yet, but brings it to the 170 level, or this massive, and I mean absolutely massive A to B pattern here that projects up to that 173 level. So it's just telling you more things to go higher. Same way with S&P, same way with NASDAQ. Until we start breaking below the 405.97 level, I will not be bearish. I'll be looking to buy the dip. It's been rewarding me so far. As you can clearly see, I had taken profits on the JPM trade that I did, which was a earnings play along with XLF. So I'm definitely going to be playing Bank of America earnings on Tuesday for a bullish trade along with Netflix. I'm going to try running a straddle on Netflix and then do a bullish call spread on Bank of America, because I do think with the JPM report, it shows that Q2 earnings are still too strong. We haven't seen the effects of the Fed tightening completely, because the banks would have shown the weakness first, and then I'm longing the S&P, NASDAQ, Nvidia, Microsoft, Google, Amazon, and Apple. So just being transparent with you guys about where I'm sitting, on which side I'm sitting on. So S&P 500, your resistance 415.09, and the further you get above these levels right here, these peaks especially, if you close above 415 or even 416, 417, you get closer to birthing a new bull market in the S&P. NASDAQ has already done that. Once you do that, that is going to be extreme pain for the bears, and basically you can go a lot higher and then milk this rally like no tomorrow. And until we break the uptrend, stop being bearish. So with that, guys, that's really as simple as I can be. But remember, it's okay to be wrong. I was wrong. I took a bullish trade and got slapped. I took a bearish trade and I got slapped too. But then I said, okay, so I'm gonna. What was the overall market movement? Upwards. Okay, I'm taking a bullish trade, and it was rewarded. I got in a little early, but it was rewarded. So we have to see. And then if we jump over the NASDAQ, same thing as before. We have basically our previous week's highs that we have to get above, and that's pretty much the levels we have for the NASDAQ is the same week that we had before. And also, you broke the uptrend on the NASDAQ and you failed to go lower. The bears had all the opportunity to send us lower, and the thing that they could do is measly 1%. Bulls bought it right back up. It's like, guys, this is a coil winding, and NASDAQ has this massive A to B pattern on it, which is A to B, B to C, that completes up into the 450 level. That's insane. That would bring NASDAQ up into these gap fills, back into the March highs for the NASDAQ, forming this massive W here that you can see W forming here. So we're expecting to go much, much higher on the NASDAQ, and I'm definitely gonna be taking advantage of that. And how many people do you know like this rally, trust this rally? I didn't, but here's the thing. Maybe sometimes you have to look the other way when everyone's looking one way, and you have to basically say, everyone's looking bearish. There's so much bearish skewed in the market, and basically you can see it that every time we go down, they talk about recession. It's the most televised recession in history, and you basically still can't send us lower. So there's people not yet excited to buy this rally. What happens when they do? That's what's the thing. But remember, trade the levels. You have your upper level, your lower level. I do love on the NASDAQ that we bounced right on the previous week's low, broke it slightly, so it's a failed breakdown, and then push back up just to consolidate in this region. This is a coil winding up to break someone's face, and if I had to guess, it's going to be the bear's face. So once tech breaks out, S&P breaks out, creates a new bull market, it's just going to be non-stop running like no tomorrow. And with that, guys, we're going to dive into the news catalysts. But before we do that, we're going to also go over the dollar, VIX, and yields just to give you a holistic view of the market. So first, starting off with VIX. It is a dead dog. It got run over. Its carcass has been run over like no tomorrow. VIX is in this zone that it's coming back down to where it's a volatility spike possibility. However, VIX can come down all the way to the $14 and $15 level. So definitely more and more fear that can be extrapolated out of the market, and basically people saying, no, I'm not going to panic. And here's the thing. Once that idea kicks off in their head of this is the new bull market, and that really sets in, this could be very ugly for VIX, and it could be very ugly for the bears. The dollar is trying to resurrect itself. It is forming a descending wedge, which is bullish. So you do have a descending wedge here on the dollar that you're trying to break to the upside. However, until you get a confirmation break, basically trade above the 102, 101 level, then I could see that bullishness continuation. However, you just had one Fed Reserve's comments that caused the dollar to gain strength, which showed the weakness in the market. But again, it's Powell and Barr that you have to, it's Powell and Williams that you have to listen to, because they're the ones that basically sway the entire Federal Reserve system, and both of them have basically said they're going to be very data dependent. Data is coming in good for them, and that they don't want to relive Volcker's 1970s where they basically crashed the markets. I think that that's unavoidable, but here's the thing. If the bull run keeps going, take advantage of the bull run. If the bear market comes and something starts breaking, then we go and we trade that accordingly. But here's the thing. It's not all going to happen in one dang day, guys. So we can see it coming on the horizon until Q2 or Q3 earnings start to be affected by these interest rates in a very bad way, or you start seeing negative job growth or all these things, or a negative GDP print. We're not getting that bad news. Everyone wants to point to the debt ceiling. I'm like, how many times have politicians been politicians? You can guess where I think they're going to do with the debt ceiling. They're basically going to raise it. So dollar could be breaking out to the upside. And then last but not least, let's take a look at the 2-year. 2-year still in this bear flag pattern here, hasn't officially broken out, similar to the 1-year. I do like how it's wicking to the upside. So basically anytime that people get a higher yield, they go to bonds for safety, especially with TLT. I do think that TLT has more room down to the downside a little bit, but it could bounce back up if people go back into bonds. But I think if you see a resurgence in the stock market, people are going to run into tech. They're going to run into it like no tomorrow and possibly creating a bubble run up. But, take advantage of those runs right now. I think bonds are a little bit of a safe haven asset that people are going to avoid once they see how the market is performing. And with that, guys, we're going to jump over to the news catalyst for next week. All right, guys, so on Monday, we basically have nothing. There's no big news events. We have Empire State Manufacturing Index. It's expected to come in negative, but not as negative as previous months. So maybe the economy is still strong, can weather the inflation. On Tuesday, we have building permits. So that's going to be a market mover just because they want to see how expansionary or non-expansionary the economy is, and housing starts are going to be a key indicator for that. We have crude inventory on Wednesday, nothing really a mover. We do have Williams speaking, so I'm going to be very keen on what he says in the afternoon. It's going to be after market close. So again, it could be a nothing burger. He could avoid, which he has historically avoided, talking about market events when the market's not open, or even just in general, just trying to avoid it and basically saying we're just going to be data dependent, or you have my outlook already. He walks the line similar to how Powell does. And then Thursday, initial jobless claims. Philly Fed Manufacturing Index expected to come in negative, but not as negative as last month, so it could be bullish for the market, and along with existing home sales. Along with Friday, we have services PMI and manufacturing PMI expected to come in line with basically last month, so altogether a pretty non-bleak week that we don't really have a lot to go over. And with that, guys, we're going to dive into the debate section of the video. If you got watched up to this point and enjoyed the content or found it valuable, we would kindly like you to hit the. So guys, we're going to dive into the debate section of the video. If you got up to this point and you enjoy the content or found it valuable, please hit the like button. It really helps the YouTube algorithm out, and possibly consider subscribing. If you are subscribed, remember to hit the bell notification just so you get updates on our content. You don't want to miss anything. We do try to do breaking news videos when they come out if there's a big event coming out. But overall, thank you for watching. Thank you for supporting the channel. And now we're going to dive into the debate section. So, what's your thoughts on the whole week?
I don't know, man. This thing was just absolutely insane. I mean, we had CPI that came in a lot lower than expected. I mean, what, last month, or for the month of, February, it was 6? And then it came down all the way down to 5. And then the markets rallied. I mean, we did the live stream. The markets just jumped out of nowhere. And then it just kept crashing down. Then, come the earnings for the banks, you'd think, oh man, JP Morgan beat, Wells Fargo beat, PNC kind of beat, not really, but it was flat throughout. It was flat ending the week. Yet the market fell on Friday. So I have no idea. Like this thing is just, man, like talk about irrational. How about that? Talk about irrational.
Yes, but like they say, markets can stay irrational longer than investors can stay solvent. And I think it's a very clear cut. Which team is voicing that the market has to go one way or another the most right now? And it's, in my opinion,
it's the Bulls.
Well, for me, it's actually the Bears. Because, well, here's the thing. Anytime you get a bad headline, you hear them come out saying crash leg, all this stuff. But let's take that and put it to the side and see what they actually did on the chart. On the chart, they defended 411.92, which was the previous week's high. So you had a failed breakdown, so you made a lower weekly low, but then failed to hold it. And then during the day, in the last hour or two, the Bears got punched in the face by the Bulls. The Bulls punched it right above 411, came all the way to 412.46, closed it above, so it's now a weekly higher high. The trend continues. They haven't broken the trend line. NASDAQ actually broke the trend down like we covered and went sideways. And all I see is classic bull flag. That's what I see. I don't see anything else.
Flag?
Yep.
Bull flag.
Bull flag. So I do think
Your position was that the Bears are making a much higher sound right now than the Bulls.
Yeah, because the chart is not going in the favor of the Bears. The Bears, if we talked about the net speculative positions, they doubled down at 405, and now we're at 412. So
got you.
Here's the thing: you're losing the trade. they've been short since, if we go back to the S&P, they've been short since this drop over here on the S&P 500, which was back in June, that they went short. That's when the net speculative positions really flipped hard. So that price, let's say that we'll take it from the top, right? 402. Let's say that is their average price, 402 to 400. We're $12 above that. And with the continuation possibly higher. And these are margin accounts because this is futures. To trade futures, you have to have margin. As everyone knows, when you're losing trade on a margin, your broker keeps calling you saying, we need more money or we're closing your trade.
We need more money or else. Yeah, or else.
They're the mafia, as we
margin calls.
Can call. So
margin calls, yep.
The thing is, like we talked in the live stream, the CPI number came out good for the bulls. They didn't really react the way I thought they were going to react. And then the bears came in and they
crushed it.
Yeah. But here's the thing, they failed to hold it. They what did we say on the live stream? We said, don't...
Every single time we've seen this, it's always they fail to hold it, then they bring it up, then the bulls fail to hold it, then it comes crashing back down again.
Yeah, but here's the problem.
It's like a tug of war.
Well, it is a tug of war, like always, but but the tug of war is going sideways when one team has a losing trade, the other team is up billions. The bulls are up billions right now. They've been buying these dips, and you're not making lower lows. They're winning. They're profiting. Hey, I want to be a bear slightly because I see all these things on the horizon. But the thing is, like, there's the famous phrase: we climb the stairs of worry, and then sell hope. So what's happening is, in my opinion, everyone is so bearish on this market. You have to look the other way at this point because it's the most televised recession in history. You're
right about that, though. You're absolutely right about that.
So if you have bank failures, if you have recession fears, you have all this fear in the market, where do you think the market should be going? It should be going lower.
Right.
You broke the bear downtrend, you have an uptrend, and you are $5 away from the S&P birthing a new bull market. 20% off the lows, 417 something. I keep forgetting the number. But 417, basically the swing highs right here. If you break 416.66 or 417 flat, you birth a new bull market, and you can create what happened the last time we were 300,000 net speculative positions short. We covered this in the key levels. This was back in COVID. When we were here in July, this is where the last time, right here, this was the last time they went this short in history. What did it create? The biggest
bull run
in history.
Pretty much.
So here's the thing.
That was COVID right there. That's absolutely insane.
Yeah. So if you look at it being like, you have all this consolidation. It's upwards consolidation. You're breaking the symmetric wedge upwards, which price targets to the 450 level almost, or 430. So everything's pointing up. And you have the seasonality behind you where it's what they say, sell in May, come back for Labor Day. So
I've never heard of that, but sure.
Yes, the seasonality basically determines into May. You're from February to May, you're bullish. You go sideways, and then you come back for Labor Day to be more bullish again. Okay. But regardless, here's my problem with that statement. If we get a rally like we think we're going to get, and you haven't seen FOMO. Like when everyone goes bullish, that's when you need to start worrying, in my opinion, because
that's when shorts start coming out.
Well, no, that's when all the shorts have basically been destroyed. Because they're refusing to admit they're wrong, and that's the problem.
No, I'm saying when FOMO really hits, and then we go into like extreme greed, because right now the fear and greed index is on the greed side. I think we're like 4 points away, 2 points away,
let's pull it up,
3 points away from going extreme greed. And if that being the case,
fear and greed index 67, so 75.
It's actually gone down a little bit.
Yeah, it did pull back slightly. Basically, you have greed all over price breadth and everything, put call ratio. So you're having more people going towards the call side or break even. VIX is basically neutral. And the thing is, we talk about VIX. VIX can go significantly more lower. It's been down in the 15s, 14s historically, where before it gets a price discovery higher, and that means greed for the market is fear for the bulls. Sorry.
So okay, here's my question to you. So you said that you are more bullish on the market in the short term,
Correct.
but in the long term, you're bearish.
Well, I'm cautious. So here's the thing.
Cautious. Okay.
So you have a trend right now. Until that trend breaks, you cannot be bearish because you're fighting the trend, you're fighting the market, and what does the Fed have the ability to do? They have the ability to pause now. They have the data that will support them in the popular decision to pause. Now,
which is the second part of the pivot, by the way.
So now here's the thing. I don't think we're going to get cuts like everyone's saying. I truly don't. But we may get cuts later in the year if something breaks. But here's the thing. Similar to 2008, like when Mike Burry and all of them, they were 3-4 years early. So you're going to stay bearish, let's say, because if we look at the psychology of the market, right? So everyone trying to be bullish in this, and then finally they're starting to be bearish, right? So you basically say, if it goes down here, I'm gonna basically sell. So they come down here below your stop out, below your mental stop, you sell, you fear sell. And then they spend the next 6 months basically running it right back up while you're trying to short it. So they take your money on the way down, they take your money on the way up, and the psychology of it is people are trying to revenge trade, and there is a bear skew now. So what does that mean? We can go a lot higher. There is tremendous amount of bear fuel, more than I have seen back in the November CPI, the December. I have never seen this much bear fuel sitting on the market right now.
Bear fuel.
Bear fuel, yeah. The bears are the fuel. If we break the 417 level, birth a new bull market, do you not think everyone's going to go crazy? Especially they pulled all their money out of the banks.
Absolutely. Oh, absolutely. Dude, like what we have seen with markets going up, 2% or whatever, forget about it. It's going to do probably like 12%.
And here's the thing.
If we reach that full... Because think about it. We have the mentality as, you take this tweet as you take it, but Michael Burry said there has never been a generation of effing buying the dip. So add the buy the dip mentality to a new bull run. Oh, man. It's going to be like, we need to buy now because tomorrow it'll be higher. So then it's like a self-fulfilling prophecy.
It's a psychology. You're playing psychology. But here's the thing. A lot of smart money has gone out of the market, and here's the problem that hedge funds are fundamentally faced with now. The S&P is running up because retail is running it up, and they have their clients coming to them saying, "Hey, the S&P is up 10%. What are you up?
Why aren't you doing it right?"
Yeah, are you up 15 or 20%? You're supposed to be beating the market.
Yep.
And they come back and they say, "Yeah, we're only up like 2%." I can go buy stinky S&P versus giving and paying you to manage my money.
Right.
I can go buy stinky S&P and stinky NASDAQ and literally make more money in a month or two than you made me in the whole year, pal.
Yep.
So it's like there's the conundrum. Do hedge funds start buying now? Do they start risking on? Now,
but now we have to. But wait. Now we have to add on top of that the T-bonds. Because I just looked up the yields on the T-bonds, and the 3-month, it is almost 5%.
Yeah, so you can literally people can buy bonds and get their money's worth in 3 months. So
and an interest of 5%.
Here's the other thing.
An interest of 5%, which is massive.
Well, here's the other thing. What happens when we birth a new bull market in the market, which is very high probability. Like if we're playing the odds here, you have a higher probability of birthing it versus not birthing it right now. What happens with bonds? Everyone's going to flood out of bonds and then run right to the market because everyone...
Wait a minute. If they flood out of bonds, that means that the price goes down, so the yield's going to go up even higher.
Yep.
So that's going to cause a lot of problems with the banks at that point.
Yes, but then institutions may go to bonds because then it's severely discounted, and you may get a thing where you create two parallel economies where you have retail buying the market, buying tech, and then you have institutions buying bonds because bonds are a guaranteed return, so their risk portfolio
They're literally risk free, and on top of that, you have a 5% yield on some of these, or close to 5% yield. So yeah, I could definitely see that.
There's a way for both sides to make money, and I don't like.
But here's the thing: if I had my money with one of these, with one of these brokers, or like a hedge fund or something like that, I would just be like, no, put the money into the treasury bond. It's a higher yield and it's guaranteed a zero risk,
Which they may be going
investment. Right. So it's like, do I care if the market goes up? Sure. I mean, it may go up a significant amount of points. Let's just say it does 10% on average a year. Well, the 3 month is giving me 5%.
Well, I looked up historically. Every time you had the first quarter be green on the S&P, 15 out of 16 times you had a green year followed by several preceding green quarters. One time, which was the 1970s, ironic, right?
Yeah.
You had a 26% crash. I don't think, and this is the one thing that's convincing me, I don't know. This is when I start questioning, do we get the crash? And it's when you know me long enough that I have to see something that breaks my understanding of everything to say this.
Yep.
The monthly. So this is Lux Algo, and here's my problem. Being bearish. I have a MACD crossing on a monthly chart. I have RSI crossing over 50.
Okay.
On a monthly chart, it takes months to show a different trend.
So what does that mean though?
I think you have the ability to revisit 450 on the S&P before you even show a breaking of the pattern. I think S&P has the ability to squeeze, and I mean squeeze, to possibly, and I'm not saying it's going to happen. You have to see more data. We have to see how the monthly.
Yeah.
But until you make two things: a monthly lower low, meaning or break the previous month's low. Like we covered, 409 is the previous month's low. So until you break the previous look back month's high or close of the high, then I will not be I won't be bearish on the market, because this graph is telling me, if I looked on this on the daily, right? Anytime we look on the daily, let's look at the S&P for an example. So MACD is starting to curl towards one another. RSI.
It's possible to zoom in on that.
Yeah, you're right.
Just that way.
We'll make it pretty simple. We'll make the MACD pretty big, and we'll make the RSI even bigger. So these two.
There we go. Much better.
What's going to happen? You're going to start curling, and you're going to go up. Your RSI is over 50. Market's been going up, and we can go back in history to see when that happens, right? So look. Pinch here, market rips up, RSI is above 50. It's just like RSI MACD is the simplest mechanics for technical trading. Like I use this all the time, and the market has basically just rewarded me by using simple stuff like that, and price action. But if we look at the monthly, I'm gonna make this as simple as I humanly can.
Okay, go on.
What's the biggest green bar? Last month's high.
Right there.
Yeah.
Oh, that was last month. Okay.
Last month.
Okay.
You had a ginormous push of green volume on the month. So what are indicators? They just speak to you in price and volume. That's all they do. They interpret price and volume. Price is going up, volume is going up. It's a very simple trade for me. Basically, until we show bearish volume, confirm with price, there's no reason to be bearish. Run the market up. If the market wants to make new all-time highs, let it make new all-time highs and take advantage of it.
Yeah, I fully agree with that. See, my version of this though is that, unfortunately for the fundamental side of things, right? This is the technical side of things. So the fundamental side of things, just looking at the most basic metric, PE. PE doesn't really tell you much of anything, right? Because, I mean, the price and the earnings could fluctuate in whichever way, right? But it's usually the most simplest metric to see, to guide you, to give you like an indication of like, it may be heading this way or it may be this way. The problem is the majority of the companies, specifically in the NASDAQ, right? Specifically in the NASDAQ, and even some of them in the S&P, because I mean, they have a lot of overlap. The PE is like way above 20.
Yep.
The PE is way above 20. And the average, I believe the S&P PE, the S&P 500's PE is, I believe, at around like 18 or 19. So I'm giving them the benefit of the doubt and just saying 20. We're like, some companies are trading in like 30, 40, 50, 60. So just based off of that alone, not even taking a look at the cash flows, just taking a look at that alone, it's telling me that things still need to fall, right? Or the other side of this is maybe things don't fall, right? Things continue going in the same direction, but cash flows in general go up to such an exponential growth in the next upcoming quarters or even years that the PE, because the earnings have gotten higher so much at such an exponential rate, it pretty much brings down the entire PE by itself, right? Because it's price divided by earnings. So if the earnings if the earnings get bigger, making the fraction smaller,
Yep.
right? Because the earnings is the denominator.
And also,
So if the earnings grow faster than that of the price, then that could be another way that just the PE alone gets down to a more reasonable level of like, let's say 20 to 25, right?
Yep.
Now, that's just earnings alone. That's just PE alone. Now we have to take into account the free cash flows and all that stuff, right? Because every investment is the present value of all future cash flow. So if the earnings go up, most likely the cash flows will also go up too.
Yep.
So I don't know. Like, I really do not know what's going to happen because I do not have a perspective as to where earnings are going. I could say that earnings will continue to go up, right? But at what rate? That's the problem, is that you can't just say, oh yeah, if they continue to go up, by this margin every single quarter or every single year, if the price goes up higher than that margin, then you're still at the same spot. So you haven't gotten back to a good ratio, right?
Yeah.
So that's kind of the problem when it comes to fundamentals. That's why if you just take a look at just the PE alone, it's telling you that things need to fall, right? But at the same time, things don't have to fall. Things could just either not, like the price could just not go up as fast, but earnings go up as fast or faster. Then that will also bring down, I guess, the ratio of value. So but the reason why most fundamental investors are saying it needs to fall is because it's easier for things to fall than it is for companies to just gain exponential growth when it comes to their earnings or their cash flows.
And you can also have something what's like termed like a rolling recession, where companies that aren't built to survive these tightening environments, basically their cash flow leaves them and goes to these bigger companies that prop up the market, like your Apples, your Microsoft, your Google. And you could almost have like a consolidation of the market where value is consolidated in a certain area, but due to that, you may get, like you're saying, they may get more concentration of their earnings. Just look at JP Morgan. Like, we both thought the banks were going to paint, I think we were bullish on them, but I think that we weren't expecting JP Morgan and Citi. Like, there was no bad news. Like, the banks basically came out and said stellar earnings. I
mean, in regards to JP Morgan, in fact, let me actually pull this up right now. JP Morgan beat revenue by such a JP Morgan beat revenue by $2.6 billion. Right? So that's insane. EPS normalized actual $4.10, beat by 73 cents. That's a lot. That's a lot. EPS gap actual, the same, $4.10, beat by 69 cents. That's insane. Right? That's absolutely insane. And you even have over here, like, the next quarter. So they already have estimates for when they have earnings again in July, like in July 14. 7 out of the total of 9 revisions are in the positive right now. Like, I'm looking at it right now. 7 out of the 9 are in the positive. 2 are in the negative.
Yeah. So it goes back to
This
if-
is like FOMO to no end.
Well, it's not FOMO. It's. I think
No,
because
not FOMO, but it's more like it's not FOMO, but it's more like, oh, things are doing good, so skyrocket.
Yeah, but
right?
you also, because everyone's had such a bearish skew that they don't realize what's coming in front of them, and then it's the emotional trip of what it shoulda, woulda, coulda. Until basically, this is like the simplest way you can trade the market. Until you start seeing bleeding in the banks, which will show before tech. I think because banks are directly susceptible to the interest rate conditions and all that.
Well, no, banks are banks. I mean, you know why they're called banks?
Why?
So this is actually interesting. What is another type of bank? A river bank, right? Mm-hmm. And what does a river bank do?
Accumulation of.
No. What does a river bank do?
I don't know.
It controls the water that goes across the river. It controls the liquidity of the water that goes across the river.
Okay.
So what do banks do? They control the flow of money that enters every other sector of the economy.
And
You get
you're
me?
just getting now tightening credit conditions, which takes
Right.
2 quarters to get through. So honestly, just to wrap it up, you could not see the crash leg per se until maybe 2024. The way
Yeah.
that things are going, because here's the thing, you would expect to see the weakness in the earnings. We're in April, so the jobs numbers are starting to decrease down. They're increase. So let's say it takes you all the way to September to start seeing it like negative job numbers, which will then take you all the way to December or November before you see the earnings maybe being affected. So
And you also and let me stop it right there too. You also have to take into account that whatever earnings you're seeing is not the current quarter, it is the previous quarter.
Yep.
So if you're in Q4 and you're getting numbers in Q4, those numbers are for Q3.
Which
That
is-
already passed.
Yeah, which would be the anniversary of the Fed finishing tightening or their crazy tightening cycle. So where all the consequences, which you would expect to show up, which is Q3. From now till
Right.
then, the bulls can run this up like no tomorrow.
And if that happens, you know what you do?
Sell puts.
Make money. That's
Yep.
it. At the end of the day, doesn't matter what the market's doing, if it's going up, if it's going down, just make money. That's it. This is the end of it. Anyways, I think that will pretty much do it for this video, everybody. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow us on the New Tick sites. Link is in the description below. So with that said, peace out, and we'll see you all in the next video.